welcome everyone. Okay, let's dive into this. Today, we're unpacking what is basically the ultimate wealth building dilemma: active creation versus passive growth, or, as it's more commonly known out in the real world, starting a business versus investing. Now, if you've ever sat there and wondered which path is actually better for your own financial future, you're absolutely in the right place. In this explainer, we're going to look at the raw facts, break down the actual mechanics of both strategies, and figure out how to navigate this massive financial fork in the road.
Time or money? Which do you have more of right now? I really want you to think about this for a second, because this is absolutely the critical resource question. See, there's literally no universal one-size-fits-all answer to whether business or investing is the better route. The right answer for you? It comes down entirely to what resources you already possess. So, do you have an abundance of free hours, or do you have a stack of saved capital sitting around? Your answer to that question is basically the core framework for self-diagnosing your best financial path.
Section 1. Conceptual anchors. Let's define the paths.
To make an informed decision, we first need to set up some conceptual anchors, just to define the fundamental mechanics we're dealing with. First up, let's define business. At a high level, business is entirely about active creation. It means creating a product or service that solves a real problem or provides value and then selling it for a profit. I really want to emphasize that word, active. You are building something from, absolutely nothing. You are the literal engine driving the value creation here. Conversely, let's look at investment. This path is defined by passive growth. It means allocating capital into assets with the expectation that they're going to generate income or appreciate over time. Notice the stark contrast here. Instead of that active creation we just talked about, you're leaning into the passive aspect of letting your existing resources, your capital, go out into the world and do the heavy lifting for you. Section 2. Path 1. The active path. The active path is all about high effort, intense focus, and bringing a vision to life. It requires immense sweat equity. Now, what's really interesting about this slide is how we can visualize this with a quick story. Think of an entrepreneur. Let's call her Sarah. Now, Sarah has plenty of time and drive, but not a ton of money, so she decides to write, illustrate, and publish a whole series of children's books to build a personal brand. Or maybe she's coding a brand new tech startup in her garage. This requires sheer creative hustle. She's pouring her own time, energy, and skills into the project. And that right there is the pure essence of sweat equity. And the benefits of Sarah's active path are just massive. First off, unlimited upside. Your earning potential isn't capped by some average market return. It's literally only capped by the size of your market and how well you can scale. Second, total control. You're the one in the driver's seat dictating the marketing, the design, the daily operations, the whole shebang. Third, asset creation. This is huge. You are building a tangible asset from scratch that can eventually be sold for a massive multiple of its earnings. And finally, creative fulfillment. Honestly, there's a deeply unique satisfaction in pulling an idea out of your own head, shaping the narrative and bringing it into the real world. But we have to be realistic here. The active path is notoriously grueling. Look at these cons. It is extremely time-consuming. Especially early on, it demands incredibly long hours and your constant, undivided attention. The high failure rate? That's just a statistical reality. A lot of businesses fail in the first few years. Then there's the operational stress. You are managing literally everything, from customer complaints and supply chains to, you guessed it, taxes. And perhaps the toughest hurdle of all is the delayed gratification. It often takes months, sometimes even years, before a business becomes profitable enough to pay its founder a reasonable salary.
Section 3. Path 2. The passive path.
Now, let's shift gears completely and look at the alternative. This approach replaces the sweat and grind of daily operations with a much more measured, autonomous strategy based entirely on capital allocation. Let's contrast Sarah's hustle with another example. Imagine David. Now, David works a really demanding job and just doesn't have the time to build a startup, but he has saved up existing capital. So instead of sweat equity, David uses capital allocation. He buys real estate, or maybe he analyzes current news and macro trends to buy equities in established markets, like the energy or tech sectors. David isn't building the machine from scratch, he is buying pieces of machines that are already working. And this leads us to what might just be the most beautiful concept in all of finance. Thanks to compound interest, your wealth can grow autonomously while you sleep. It's incredible, right? It really is mathematical magic. Once your capital is deployed, your money simply takes over the heavy lifting. Let's break down the advantages here. Obviously, passive income and compound growth are right at the top, but look at time freedom. While the initial research takes some dedication, holding the investment requires zero day-to-day operational work. Then there's high liquidity, especially in public markets. If you invest in publicly traded stocks, you can buy or sell your positions in literally seconds. Compare that to trying to sell a private business, which can take years. And finally, instant diversification. You can spread your risk across totally different sectors immediately, preventing all your financial hopes from being tied to just one single product or company. But hey, the passive path isn't a flawless paradise either. The primary downside is a total lack of control. You have absolutely zero say in how these companies are actually run. If a CEO makes a terrible decision, well, your portfolio takes the hit. You also face market volatility. Global news, random interest rate changes, or natural resource discoveries can cause wild, unpredictable swings in your investments, and that requires some serious emotional discipline. And the harshest reality of all, it requires existing capital. To see truly life-changing absolute returns, you generally need a pretty substantial amount of money to start with. Section 4, the head-to-head matchup. So the crucial point is, how do these two paths actually compare when we smash them together in a direct matchup? It really boils down to these stark contrasts. Absolute control versus zero control, sweat equity versus existing capital. As a learner navigating all this, you really have to weigh the heavy burden of managing micro details in a business against the complete helplessness of enduring macro market swings in investing. Basically, which kind of stress do you prefer? And this brilliantly illustrates that comparison. Let's walk through this 7-factor breakdown together. Just look at effort. Business requires high active effort, while investing is usually low to moderate. In terms of risk, business carries a really high startup risk where all your eggs are basically in one basket, whereas investing offers a more moderate, diversified risk. The return potential in business is very high, but investing yields a steady, moderate to high return over the long term. For control, business is high, investing is low. Time to results can be fast or even zero in business, but it's almost always gradual in investing. Capital needed to start a business varies wildly from very low to very high, but investing almost always demands it up front. And finally, stress. Business operations are high stress. Passive investing is generally lower stress. Section 5. The ultimate verdict. After examining the conceptual anchors, the detailed pros and cons, and our head-to-head matchup, we arrive at the ultimate strategy. So, which is actually better? Well, business is the best way to generate wealth, especially if you have the time, the drive, and you want total control. Investing, on the other hand, is the best way to multiply and preserve wealth, protecting your time while analyzing macro trends. But you want to know the real secret? Let's move to and see how this builds, because many of the most successful people actually do both. Step 1, they build a business to generate high active income. Step 2, they strategically invest those exact profits into the broader market to build long-term passive wealth. They literally use the active path to fund the passive path. Which brings us right back to where we started. Time or money? If you have time and a vision right now, perhaps it's time to build. If you have capital and want some freedom, perhaps it's time to allocate. You now understand the core mechanics of both paths. So the only question left is, which path are you starting today? Think about it, take that first step, and I'll catch you in the next explainer.